All right, welcome everybody to the Venture Deals AMA with Brad Feld. This is our second AMA for the course, and today we'll be talking with Brad, where he'll be answering your questions pretty much about anything, but if you have questions focused on assignment number 2 or the second week here of the course, that'd be a great way to kind of limit the topics. To ask questions on the YouTube site there, if you go into the chat section on the right-hand side, post your questions there. I'll be monitoring those. And while you start putting in some questions there, we'll start out with a question from the forums from earlier, which is, Brad, you historically have talked about venture capitalists and raising money kind of akin to Dungeons and Dragons characters. Could you help entrepreneurs, as they're thinking about building their investor pipeline, put that lens on, and what does that mean for entrepreneurs as they're reaching out to investors, figuring out who should be in their kind of top end of their funnel, and then how the different characters progress the deal?
Yeah, so I think it's really important to understand the metaphor came from my own frustration that lots of people were referring to the idea of a venture capitalist as a singular archetype, right? People would talk about, I need to go raise V, or I'm approaching VCs, or I'm talking to a VC, as though all VCs were the same, and they're not. And so the metaphor is that literally you're dealing with VCs where each individual venture capitalist, in Dungeons and Dragons or Lord of the Rings, for people who are too young to know what Dungeons and Dragons are parlance, some are orcs, and some are elves, and some are wizards, and some are trolls, and some are dwarves, and they've all got different experience levels, and they've all got different sort of things in their bag of tricks. So the implications of that for an entrepreneur, especially when you're out raising money, is that you should do the work in advance to understand what the individual VCs are like. And you have to go deeper than the firm. It's not the venture capital firm has a specific archetype, but the individual participants do as well. So within Foundry Group, if you know us, I'm different than my partner Jason, who's different than my partner Seth, who's different from my partner Ryan. We work collectively in a certain way, and our differences are actually very additive to all the dynamics about how we approach things. But if you approached us all the same way, or generically without any understanding of what we liked or what we responded to, you're going to waste a lot of your time, and you're going to be a lot less effective at approaching and understanding VCs. The other dimension on which we talk a lot about in Venture Deals, I think in the second chapter, or the first chapter, is who the players are, and all the different categories of types of funds, but also participants within funds, whether they're a managing director or a partner or an associate or an EIR, how all of these different people work together, and just really understanding the individual is super key to you when you're raising money.
Great, thanks. Another question kind of along that line. So as you think about the different characters, could you talk about the dynamics of alignment? When are entrepreneurs aligned with investors, either kind of before the fundraise process, after the fundraise, follow-on investment? What are the alignment dynamics like, and how should entrepreneurs be paying attention to that?
So before somebody's invested in your company, you're obviously in a mode where you're both selling and evaluating them as a potential long-term partner, and they're also evaluating but possibly selling you as having them as the long-term partner. So in advance, recognize that a lot of the dynamics are all about evaluating and trying to make a decision. Part of the value of the term sheet and then the funding round is to try to create very clear rules of engagement around how both parties act going forward. You're now partners in the business after the financing. The investor owns a piece of the business, you own a piece of the business, and your motivations theoretically will be aligned, or else they didn't invest in the business in the first place. Presumably, whatever your aspirational goal for the business is and their aspirational goal for the businesses are roughly equivalent. A truth in this world is that diverges pretty quickly. things happen. The business changes, it evolves, you change, your team changes, the investor may change. Motivations and drivers for you versus the motivations and drivers for the investor may be different, separate from the specific company. So having a clear understanding of how you're going to interact with each other going into the relationship is key. And then working hard continuously on that relationship is equally key. I've seen way too many good companies get messed up because an investor was unable to be effective working with a founder or a set of founders, or vice versa. The founders did not take the time to understand how that investor wanted to work and wanted to interact with them. And they didn't end up being on the same team. They ended up being opposing forces to each other. And when things go wrong, it's a lot better for you to be on the same team and have that point of view, because you'll be able to work through the problems. And if you already are in this place where you have opposing forces and you devolve into what human beings naturally do when there's stress, which is drama, blame, frustration, and oftentimes things that are self-destructive.
Cool, makes sense. All right, next question, kind of in the early stages of the investment process, when you're reaching out to VCs, how should entrepreneurs handle, when a VC goes dark or they're trying to move, progress the deal forward and it feels like it's stalling? How can entrepreneurs manage that with venture capitalists?
I like to use the phrase persistently patient. I think it's important to be persistent, but it's also important to be patient. You're in a position where you don't necessarily control the tempo of the conversation. There comes a point sometimes where you do. Right? If you have, 2 or 3 term sheets coming together, all of a sudden, the tempo shifts to be under your control versus under the investor's control when you're waiting for that first investor to show up. But very, very hard to get investors to move move at a pace that's different than whatever pace they're going to move. A mistake I think entrepreneurs often make is they create a narrative in their head about what's actually going on that has no correlation to what's actually going on. And that happens on both the positive and the negative dimension. So, you come out of a meeting that you feel was a great meeting because you were listening for having a great meeting. And in fact, the VC who gives very good meeting, right? Everybody that meets with this particular VC always says, wow, what a good person. Like, she really clear thinking and she interacts well, and I felt really good after that meeting. And then you don't hear anything for 3 weeks, and when you finally get a response, it's like, oh yeah, I get a good meeting, but it's not something I want to move forward on. The opposite is true too, where you come out of a meeting with an investor and you're like, man, that meeting sucked. Nothing went right. Like, I was totally off balance the whole time. And 2 days later, you get an email. It's like, we'd like to move forward. Time for you to meet with my next partner. So the patience side of it is that you have to allow things to unfold in their own natural order. The persistence part of it is that you have to apply energy to the system continually. But you gotta get those two things in balance. And I think the thing that gets people out of balance is this false narrative. This idea that things are either going great or they're going poorly, independent of actually the feedback.
And what can entrepreneurs do to help themselves align their narrative closer to the reality of the situation?
Try to always figure out what a next specific action is and introduce that next specific action before you disengage. You actually should relish having information that the VC wants you to provide to them as follow-up, or the next meeting that they want to have, or people they want to introduce you to. All of those things give you an excuse to do something and then email and engage with the investor. It's amazing to me how infrequently entrepreneurs approach things the same way a salesperson would. This is a sales process. You're trying to sell a piece of your business in equity to an investor for dollars, right? So they're buying equity and you're getting dollars. Run a sales process. If you have a sales background, you immediately understand the idea of a top of a funnel, and that you're working your way through the funnel, and that you have touch points that you want to follow up on. And, you have people that fall out of the funnel, but then you have people that are trying to get to the bottom of the funnel. As part of that, use real sales tools, right? There's an enormous number of sales tools in the world now that can help you manage this process. And, very simple ones like Yesware, which we're investors in, and Techstars is actually investors in as well, allow you to know when somebody's opened an email, right? You send an email and you can track it. And why wouldn't you track every email you send to every investor so you see when they're actually interacting with your email or your content versus sort of guessing as to whether they got it, prioritized it, it's moving around within their firm or something like that. The last thing is recognize that you're not in the position where you can, most of the time, you're not in the position where you can force an issue, and all of your behavior and interactions with the VC is being evaluated by the VC as they're trying to decide whether to invest in you or not. So this idea of continually engaging, but in a thoughtful way, is very powerful. I have literally had people, that I've had an email or two with show up at my office randomly that want to get together with me. That's not effective for me if you know anything about me. Another one is, start an engagement with somebody that goes back and forth in email. And I say, look, I'm really not that interested in investing in this. I'm happy to give you some feedback, connect you with a few folks. And the next thing that happens is I continue to get these long emails that are pitching me on investing in the company. Or even you'll get a phone call after I've talked to the person on the phone pitching me again to invest in the company. Listen to what you're hearing. There's a cliche of, don't ever take no for an answer. You would rather not say anything at all. And so you're trying to get to these decision points, which allow you to then focus on the investors who have the likelihood of actually investing in your company, rather than just continuing these conversations and keeping them going.
If we can go back to the sales process analogy, one of the powerful things sometimes that people do during the sales process is if they get a no from a prospect, they dig in a little bit more to figure out why, not in the spirit really of selling, but in the spirit of reflection, understanding, and improvement. What advice do you have for entrepreneurs as they get no's from investors and incorporating that into their process or how they're pitching their business?
So you will relatively infrequently get any useful information from a VC when they say no. Every now and then you might get something useful, but it's pretty infrequent. There are investors who pride themselves on always giving feedback to entrepreneurs. And my own experience is that that's way more fiction than fact. There are firms that, started off where they would say, when they were young firms, we always write a note saying why we passed. It's part of how we do things. But then as they get busier and bigger and have more deal flow, all of a sudden, they're not just not writing those notes, but they're not even responding to the inbound. The other is if a VC says no and you send back a note, can you give me any feedback? Most of the time, the VC doesn't have any incentive to give you feedback. And so you're asking somebody to give you feedback that they don't have a motivation for. They're not going to have particularly deep feedback. I say no to a lot of things. I like to try to say no in 60 seconds to everything. So if I can say no to 60 seconds to everything, I'm not going to be wasting your time. And that's really important to me. I don't want to be in a position where you're spending a lot of time with me on something that there's no chance I'm going to do. Well, I'm not going to be able to give you meaningful feedback if I say no very quickly to what you're doing. And then the last is, a lot of times the reason for the no has nothing to do with you or your business. The VC's done too many investments recently and is just not really looking at anything new. They might be out of money because they need to raise their next fund before they can do investments. They might have two companies that are completely fucked up that are consuming all their time, and they know they're not going to get an investment through their partnership. These are things the VC is not going to tell you, even if they're consciously aware of the real reason. And so I think the chance of you getting good feedback is very low. And generally speaking, unless you have a pre-existing relationship with that VC, where you've worked with them before, or the relationship is more than just sort of a very shallow first couple of interactions, I probably wouldn't ask for the data.
Great, thanks for that feedback. Let's shift gears now to convertible notes and SAFE agreements. Got a lot of questions around that. You know, when you think about doing equity deals and you're investing in companies, and you look at sort of the notes they've raised in the past or the safes that they've created before you see them, what are some of the patterns that you see that entrepreneurs, as they're raising those initial notes or creating those SAFE agreements, should avoid, or how they should think about doing it right now in that round so that the next round goes well, or they're setting themselves up for success?
There's a bunch of different issues around convertible debt and issues around SAFE, and there's a lot of I would say I was gonna say mystery, but that's not quite the right word. Maybe misdirection around it. The biggest mistake founders make is they don't realize that they actually have sold equity in their company when they issue a convertible note or a SAFE. They just haven't executed on that transaction yet. So, you know, the important starting point is recognizing that if you issue a convertible note and it has a cap, which almost all do, occasionally you might not have a capped convertible note, but the vast majority of convertible notes are capped. That's your best case of what you've sold. So, you know, if you do a $1 million financing with a convertible note with a $5 million cap, you've sold, in your best case, 20% of the company. If that company ends up, your financing ends up being done at a $3 million valuation, let's say you go through the $1 million and then you raise another $500,000, and the investor, because you've got $1 million already of debt outstanding, they're willing to give you $500,000 of the $3 million valuation. That $1 million SAFE note or convertible note, actually you sold 33% of the company. And now you're selling another 16% of the company with the $500,000 that you're raising in this equity round. So you've actually sold, you know, roughly half your company by the time that $1.5 million gets converted. So the error is not understanding that and then getting caught up in this sort of illusion that when the financing actually starts to come together, that, oh my God, this is so expensive because I have all this debt that's now converting that I'd forgot actually owns a piece of the company. Problem number two is creating situations with these notes where you don't have a good way to force the conversion into equity. You do ultimately want them to be equity instead of debt. And you want to be in a position where you have some control over that versus a situation where the individual investors have control over that. You especially don't want a small investor to have control over that, be able to hold you up. So making sure that the notes are written well, that the conversion parameters are logical, that you understand what those rules are, and that all the investors are essentially signing on to the same type of note. So you're not giving some investors different rights than others at the very early stage. Now, you might have different caps depending on the time that you raise or what you raise or from whom you raise, and that's not awful. But the same kind of thing, like the more complex it gets, the harder it is to understand what you've actually sold.
So the takeaway is have the discipline to keep it simple.
As with many things around this, have the discipline to keep it simple. And also, don't get stuck in the sort of illusion that somehow when you do issue a convertible note that you're not actually in that process selling a part of your company, right? It used to be that convertible notes and SAFE didn't have language for what happened if a company was acquired. And so if a company was acquired, there was usually either a negotiation or the note holder didn't have any real rights if the note was written a certain way, and they got, you know, their money plus some interest. I will tell you that none of your investors are investing in your companies at the early stages with the goal of getting the interest back. They're actually trying to get a multiple on their investment. And, you know, once investors started to realize that was what was going on, a paragraph got into the convertible notes and the agreements that said, you know, if the company sold, the investor has the option to either get their money back with interest or maybe a multiple of their money back, or can convert their money into equity immediately before the transaction closes at the valuation set by the cap or some other valuation. Like there's language now for that. So it's keep it simple, but recognize that the note is now almost in some ways as a traditional equity financing. Trying to drive to the point where you have real investors as equity investors versus debt investors when that's your goal is something that should be front of mind.
All right, next question that we have around when you kind of line up the early investors and you take investment, and then the kind of next round, so let's say the notes or early angels, does that help or hurt as you raise follow-on rounds? Do investors look at who's put money in, and does that exclude some investors? Does that entice other investors?
It's totally situation specific, company specific, and investor specific. At the early stages, there are a lot of investors who run in packs, who know each other, who like to follow on or participate alongside each other. So that's very helpful when you get one of those investors in the mix. You also have a situation where there are some people who don't want to work with other people. So occasionally a particular investor might cause others to not want to engage, but I'd say that's pretty rare at the early stages. Some investors are adamant that they don't want to do investments on convertible notes. Other investors are totally comfortable with it. Some investors are very uncomfortable when the amount of money on a convertible note gets above a certain level. And I would say for us at Foundry Group, whenever we run into significant convertible notes, our goal, if we're going to do a financing, is to try to figure out a way to do it and convert it in such a way that everybody feels good about. There are other investors who just don't give a shit about the previous investors and what those notes look like, and so they'll be much more aggressive about those conversion terms. So there isn't no single archetype. Interestingly, you can do a lot more research on investors today than you could even 10 years ago, right? Huge amounts of information on the web. The other dynamics around that, not just being able to get information from people on the web, is also the situation that you have lots of other entrepreneurs you can talk to and do diligence on these investors.
Next question. For pre-revenue startups, how much hand-wringing or worry should the founders, or how much energy should they put into around the valuation?
I think you should pay attention to your valuation, but you shouldn't overthink. If you're trying to build something really significant, optimizing for better early investors is worth trading a little bit on valuation. And there's lots of good examples of this, right? Uber is kind of a canonical example. I don't have in my head the exact pre-money of the first financing, but it was, $3 or $4 million, something like that. Let me tell you that those early investors are very delighted, and Uber, which didn't optimize on that first financing very much, they just rounded up the money. The founders of Uber are just fine because of the value of the company. And there's lots of examples like that. Twilio, which was a relatively recent public company, its first financing was probably done in the low single-digit millions. So, your goal of trying to build something really big, you're really more focused on the amount that you raise at that early stage, and recognize that most financing rounds, regardless of stage of the company, you're going to be giving away between 10 and 33% of the company. So even as you get to very, very late stage financings, you're still going to be giving away selling 10 to 33% of the company, just kind of where it falls. And if you find that you're doing a financing where you're selling 50% of the company in a financing, that should be the heads up, not that you're selling 27%. Now, all that said, is less dilution better from a founder's perspective? Absolutely. So I'm not saying don't pay attention to it, but don't over-optimize on it.
All right, next question, and this, we'll probably have time for one or two more here. As entrepreneurs evaluate investors, how should they be thinking about it? Should they really be paying attention to the individual investor, the firm, the quality of the portfolio companies? How do you think about how entrepreneurs should be focused during this process?
I think the firm and the individual people is the most important. And I'd rank the person the most, the investor you're interacting with, and their reputation for how they interact with other people, other investors and other entrepreneurs. Then the reputation of the firm, and recognize that there's a lot of marketing going on in the venture capital world right now. So the actual signal versus noise is low. There's an awful lot of, shit promotion of, look how great I am as a VC, or look how great my firm is, that's disconnected from the actual impact of the people or the firm. And I think their portfolio company and who they've invested in is probably the least important thing, other than understanding whether they've invested in companies that are similar to your type of companies and at the stage as your company. So, if it's an early stage investment company that has a bunch of names of companies that look like yours, has similar business models, we're first-time entrepreneurs, that's a good signal for you. Versus if it's a firm, you're a consumer-oriented startup that doing something with consumer and mobile, and all of their investments are hardware-related investments, or all of their investments are, SaaS-based investments. Understanding what that landscape is useful, and also being thoughtful about the difference between logos and deep engagement. There was a trend, it's kind of died down now, which is nice, but there was a trend a couple of years ago, maybe 4 or 5, writing very small checks into high-flying companies at mid and late stage valuations, just to put the company's names on their website. Hey, we're an investor in this company. And that's not really substantive. It doesn't really help you understand them, and it's worth sort of knowing, are they on the board? Are they actively involved? Did they make a difference? And most cases, entrepreneurs will be pretty open with you if you have a reason to reach out to them.
Great. Well, Brad, it was wonderful having you here. We are at our 30-minute time block on this.
My pleasure.
Really appreciate you joining us, and we'll see you next time for the next one of these.
For everybody out there in the U.S., have a wonderful 3-day weekend. And for everybody that's not in the U.S., have a wonderful 2-day weekend with a 1-day pretend weekend in the U.S.
Thanks, Brad.
See you. Bye.